All right, welcome. So today we're doing something a little different. We're not going to try and sell you health insurance. Instead, we're going to take it apart piece by piece and look at it from an investor's point of view. How does this business really work? We're about to pull back the curtain on the key strategies insurers use to protect their bottom line. Let's dive in.
Here's how we're going to break it down. First, we'll talk about a really important idea called skin in the game. Then, we'll see how the insurance business, by its very nature, creates a huge problem for itself. After that, we'll look at two clever levers they pull to solve it: co-payments and room rent caps. And finally, we'll wrap it all up with the big takeaway for any investor.
So, let's kick things off with a foundational concept. It's one of those ideas that, once you understand it, you start seeing it everywhere. It's called skin in the game, a term really brought into the mainstream by the author Nassim Nicholas Taleb. And at its core, it's all about a simple but very powerful rule. You should have something to lose in any decision you make.
What it really boils down to is balance, or symmetry. You shouldn't get all the upside of a decision if you're completely shielded from the downside. See, when everyone shares in the potential rewards and the potential consequences, something magical happens. Everyone's incentives line up, and that usually leads to much smarter, more responsible decisions.
This quote just nails it, doesn't it? If you get hurt, I get hurt. It's this idea of a shared fate. Whether you're talking about business partnerships or life in general, this is really the bedrock of trust and accountability. And you see this principle play out all over the place. Think about it. A pilot has the ultimate skin in the game. They're on the plane with you. A great chef is going to make sure the kitchen is spotless if they're eating the food too. And a general who leads from the front, that's someone who inspires incredible trust. In every single one of these cases, their personal risk ensures they act in everyone's best interest. Okay, so that all makes perfect sense. But here's where things get complicated for the insurance industry. The very design of an insurance contract completely shatters this principle. It creates an imbalance, an asymmetry, and that becomes the single biggest problem an insurer has to solve. Just look at the contrast here. On the left, you've got symmetry, right? The pilot shares the risk with the passengers. But on the right, you have the core of what an insurance policy is: pure risk transfer. You pay them a small fee, a premium, and in exchange, you hand over this giant financial risk of getting sick. And just like that, your incentives and their incentives are no longer aligned. And this, right here, is the central headache for every single health insurance company. They need you, the customer, to be careful, to be frugal, to maybe even pinch pennies when it comes to medical expenses, even though they're the ones paying the bill. But once you're fully covered, you have zero financial reason to do that. This misalignment is the fundamental problem they have to fix if they want to stay in business. So how do they fix it? How do they solve this massive problem? Well, let's look at the first major tool in their toolbox. It's called the co-payment, and its entire job is to force some of that skin in the game back onto you, the customer. Let's walk through a super common scenario. Imagine you're buying a policy. The agent says, "Hey, I can knock 25% off your annual premium." Sounds great, right? But here's the catch. You just have to agree to a little clause that says you'll pay 20% of any hospital bill yourself.
That 25% discount feels awesome. It translates to maybe 1,800 rupees in your pocket right now. It's real, tangible money. And that makes some potential future costs seem, well, pretty vague and far away. So accepting that clause feels like a pretty smart financial move.
But, of course, life happens. 9 months later, there's an unexpected medical issue, and you're looking at a 2 lakh rupee hospital bill. Your first feeling is probably relief. Thank goodness for insurance. But this is the exact moment that that little clause you agreed to suddenly becomes a very big deal. So let's do the math. The insurer pays 80%, which is 1,060,000 rupees. But that 20% co-payment you agreed to, that's 40,000 rupees that you now have to find and pay out of your own pocket. From the insurance perspective, this is a huge win. They just instantly reduce their payout on this claim by a massive 20%.
Now here's the kicker. That 1,800 rupees you saved on the premium seems pretty tiny now, doesn't it? In fact, it would take you about 22 years of saving that premium just to break even on this one payment. For an investor analyzing this business, this isn't a trick. It's a brilliant, fundamental risk management strategy, a massive victory for the insurer.
All right. On to the second major tool in the insurer's kit. And this one is a lot more subtle than a co-payment. But believe me, its financial impact can be even more powerful. And it all revolves around one tiny detail: the daily rent of your hospital room.
You see, a lot of policies will put a cap on how much they'll cover for your room each day.
A common formula is 1% of your total coverage. So if you have a 5-lakh policy, your room rent limit might be 5,000 rupees per day. Now, you might think, okay, if I choose a nicer room that costs more, I just pay the difference, no big deal, right? Well, not exactly. Let's break this down, because this is where it gets interesting. Let's say you pick a room that costs 10,000 rupees a day. That's double your 5,000 rupee limit. So you know you have to pay that extra 5,000 for the room, but here's the hidden part. Because your room cost was 100% over the limit, the insurer now says, okay, we're only going to pay 50% of all other associated costs too. So that 50,000 rupees surgeon's fee, you're suddenly on the hook for half of it, another 25,000 rupees you probably never saw coming.
This incredibly powerful mechanism has a name. It's called proportional deduction. The insurer is basically linking its financial responsibility for almost the entire bill, the doctors, the tests, the medicines, directly to the class of room you choose. By going over that one limit, you kick off a domino effect of deductions across the whole bill. It's a very, very effective tool.
Okay, let's zoom out and put all this together. It's time to put on our investor hat. When you look at clauses like co-payments and room rent caps, what are they really for? What do they mean for the long-term health of an insurance business?
From an investor's viewpoint, these aren't just little tricks in the fine print. They are absolutely essential tools for survival. They directly cut down how much the insurer has to pay on each claim. They gently, or not so gently, nudge you, the customer, to be more cost-conscious. But most importantly, they reintroduce skin in the game. They shift the whole model from being a simple transfer of risk to a system of shared responsibility. They are the bedrock of how an insurer protects itself from going under.
And that really brings us to the final, crucial question. A regular customer might look at these clauses and see them as unfair gimmicks designed to get out of paying a bill. But an investor has to ask a different question. Are these the very mechanisms that guarantee this business can actually survive and stay profitable for the long haul? That, right there, is the key takeaway. Thanks so much for joining me.